Tuesday, June 23rd, 2020, Maneco 64, home of alternative economics and contrarian views. Today we're going to look at the gold mining sector. I think there's opportunity there for those of you who invest, for those of you who trade. You need to decide, of course, what you're going to do, what your time frame is going to be in terms of investing or trading. And this is by no means investment advice. I'm just telling you what I think and what I've done. And am I saying people need to rush back into the financial system and have a lot of capital at risk and counterparty risk? No. And that's why I have speculated in the last few weeks in this sector. But for example, if the money I put in that sector were to disappear for whatever reason, for reasons of a huge financial crisis that could come again because of a second wave, I wouldn't lose sleep over it. But at the same time, I think, personally, one needs to take some risk once in a while. And I'm not changing my tunes. I still have my physical precious metals, gold and silver. I'm still trying to accumulate precious metals and other tangibles. But looking at the overall commodities market and the paper markets and the mining stocks and gold and silver, I think there is quite a bit of opportunity in the miners. And I'm going to look into that today. And at the end, I'll look at the market, see where they are. I won't touch upon what's going on in the world in terms of politics, economics. We're just going to look at the markets and see where we could maybe find some opportunities. And one thing I would say, nothing is ever certain in financial markets, but there is such a thing as the probability of something maybe working, and you need to, of course, and I've been at this for many years or decades, you need to manage your risk. You need to make sure you are, how can I say, in a position where you can do this and not risk all your savings or even risk some of the assets that you have to survive, like your property, your house, or whatever. So before I go into the miners, I wanted to look at a really interesting piece here. It's called In Gold We Trust Report 2020. I'll put a link to it in the description below. It's written by Incrementum of Liechtenstein. Liechtenstein, of course, is a small country within Switzerland. It's an interesting place, very small. But this is what they say about the money flow, where the money is going, where it's been. And I think this is why commodities and precious metals and gold miners in particular are an interesting opportunity with little downside risk, I would say, and a lot of upside potential. So this is what they say. Where does the money flow to? It is very possible that external monetary policy will trigger a renaissance of hard assets. If that thesis is correct, the battered commodity sector should also offer opportunities to courageous contrarian investors. Relative to the Dow Jones Index, commodities are currently trading at the lowest valuation level since the mid-1960s. Compared to equities, commodities were undervalued to a similar extent only before Black Thursday on October 24th, 1929, and during the exaggerations of the dot-com bubble. So here's the chart. So this is the Goldman Sachs Commodity Index over the Dow Jones Industrial Average. That's the ratio. And that's how far down it's been. Yes, of course, it could stay down here for longer, but who knows? I personally think with what Incrementum is saying about the external money printing, all the policies of fiscal stimulus and monetary stimulus, I think we could see this start to shift. And with all the uncertainty as well about the real economy because of the health crisis, because of the prospects of maybe having a second wave. It's just what we've been told by the powers that be. It's almost like they're saying there will definitely be a second wave. You only need to listen to people like Dr. Fauci, Bill Gates, all these people who are, in my opinion, helping orchestrate or manage this crisis, so to speak. So let's have a look what they say, what else they say. It says, let's take a closer look at the two phases in which commodities were so favorably valued compared to equities at the onset of commodity bull markets. What both phases have in common is that they were preceded by massive monetary inflation. So we do have that right now. Yes, I know the Federal Reserve in the previous reporting week, they actually did quantitative tightening. Their balance sheet, their assets dropped by 74 billion. We're hearing a lot of warnings by people like the Bank of England. Yesterday, it was Andrew Bailey, the governor of the Bank of England, said the government and the market should not expect lasting QE like they've done this year of a total of 300 billion. Are they going to pull the plug? And is the Fed pulling the plug? I don't think so. It's a possibility, like I said, but we'll have to wait and see. Right now, it seems like it's going to continue all the money printing. And even if they don't print more money or create more credit, which is really what they're doing, creating fiat credit out of thin air, I think they will keep interest rates low, near zero, or at negative like the ECB. So if the economy picks up and there's a lot of unemployment at the same time, and it might sound paradoxical, but you could have, of course, the economy pick up because we had a shutdown. But we could have a stagflationary environment of low growth and high inflation. So that makes sense. So with precious metals where they are, they're starting to do well. The bullion, gold bullion, and silver bullion. I wanted to talk about these ETFs that I started buying late May and early June. So here they are. I can show you that I've done the trades 27th of May and 2nd of June. So I bought the Van Eck Vectors Junior Mining ETF and the Van Eck Vectors Gold Mining ETF. You can see there. I've cut out, of course, how much I bought, but you can see there's a plus there. So I've been accumulating this. It has done well, and it has also gone down to slightly negative. Yesterday it did well again, and we're back to positive, but I'm not trying to tell you that I'm making money or anything. I'm just trying to tell you that it's quite volatile, so you need to be aware of that. So there's two ways to do this, depending what access you have to these ETFs, how good your broker is. You could buy the ETFs, or you could go into Yahoo Finance website, for example, like I've just done here, Van Eck Vectors Junior Gold Miners ETF, and you could go into holdings, and you could look at their top 10 holdings, which is 45.49 of their total assets. And you could try to mimic it and buy each stock separately, but you'd be missing quite a bit of their holdings unless you can go onto their website, VanEck, and maybe get all of the holdings. You might be able to do that. I haven't done that here. So it shows you the top 10 holdings for the junior gold miners. And what's the difference between a junior gold miner and a normal gold miner? Well, junior gold miners are usually the smaller exploration companies, or companies also that are already getting the gold out of the ground, but they're quite small. So I would also do a little bit of research on that. Look at the difference. And then you have the normal gold mining companies, which is the GDX. The junior gold miners is GDXJ. So VanEck Vector's gold miners. So their top 10 holdings, you've got big companies that have been around for even decades, like Newmont Corp, Barrick Gold, Franco-Nevada, Wheaton Precious Metals, and so on. These are companies with proven track record. And what's the difference in terms of how they will react to a rising price of gold? I would say there's more leverage in the GDXJ because there's more uncertainty in terms of what gold they have, how much gold they have, if they're going to be able to get the gold. So yeah, that's why, for example, there will be more leverage. It will go up more if the price of gold goes up. They will go up faster than the GDX, but they will also fall faster if the price of gold goes down. So it's a double-edged sword there. So yeah, and that's what I've done. I could have gone over the prospectus of VanEck and maybe found out more and more about the holdings, and have done it each company and bought separate the separate companies. But I decided to do the ETF. It's easier, it's more convenient. Of course, yesterday there was some news about Credit Suisse. I think they said they're gonna discontinue selling exchange traded notes. That's different than ETFs on gold and silver and other commodities. Why they're doing that? Well, because I think they're concerned about the volatility, about the risks. So keep that in mind. But ETFs are different than ETNs. But yeah, there is a risk, of course. Your broker could go bust. VanEck could close down. It's unlikely, though. And that's why, though, I'm not putting betting my house on this thing. So this is what I've done, as you've seen, end of May and beginning of June. I'm not sure I'll add on more to it. We'll have to see. So now I wanted to show you how GDX and GDXJ are nowhere near their high from 2011, for example, when gold made an all-time high. As you can see here, GDX was above 60 at the time, and now we're in the mid 30s. So there's still a lot of room, and you look at the gold price, we're a lot closer to the all-time high than GDX is to its all-time high. And if we break through the all-time high in gold, there's even more potential for GDX. And the interesting thing about the gold miners is that, for example, if the price of gold goes up from 1,700 to 1,900, that's $200 you make on the bullion. But let's say a mining company is making $100 per ounce, let's say with gold at 1,700. With the move from 1,700 to 1,900, they will increase their earnings from 100 to 300, and that will make a huge difference for their stock price. So that's why gold miners are highly leveraged compared to gold bullion. And so let's look at the GDXJ. I think GDXJ is even more undervalued, as you can see here, relative to gold bullion. We got up to like 175 or thereabouts back in 2011, and we're still below, just below 50. So there you go. That's what I wanted to talk about today. In terms of the markets, it's 8:15 a.m. London. Right now, we've got gold trading just around 1750. It's down about $4. Silver is at 1770. Yesterday was a little disappointing. We got up to 18, and then towards the end of the day, we traded lower. We're seeing the Dow futures up about 84 right now, 1/3%. I saw a headline about President Trump saying that the trade deal with China is fine or something. I'm not sure. But anyway, people are attributing the rise in the stock market yesterday to this. The currencies are fairly steady, really. Not much change. Sterling is unchanged, basically at 124.74. We did see it go up yesterday. The pound was up almost 1%. I think it's on the back of the Bank of England trying to calm down the markets. I think recently sterling has dropped quite a bit, and I think there's a bit of concern that the Bank of England is just going to print money like they did last week and announce another 100 billion. So they're trying to, how can I say, keep the markets calm about the credibility of their policy. I'm not too convinced. The euro is up 0.2%, almost back to 113. We're at 112.85 versus the dollar. And the dollar is up 0.25% versus the yen at 107.16. So again, all these fiat currencies, all they do is like go back and forth, up and down versus each other. That's why you need to focus on the precious metals. They're going to keep going up against all of them, in my opinion. So just to finish off, crude oil is doing well. There's that commodity story of commodities being really undervalued. We need to see other commodities other than gold and silver going up as well. And this is encouraging here. We've got crude above $40, which is a key level. We're at 40.68, pretty much unchanged. So there you go. Do a little bit of homework. If you've never invested in the stock market, you need to do a lot of homework. And I'm not advising people to buy GDX or GDXJ. I'm just telling you what I did, and I think there's good potential for it. As you saw from those charts, the upside potential is much bigger, especially for the GDXJ. But as you've seen, I bought both. So I bought the same amount each time of both. So you might want to do it differently. You might want to put all your funds into the GDXJ or the other way around. So hopefully you enjoyed this kind of video, a little more about trading, investing, and the markets. If you did, make sure you hit that like button. Please share this video far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, the new platform Parlay, and all these other platforms below here. I wish you all a great day. Take care. Bye.